Welcome everyone to the Kindle Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. In yesterday's action, we saw a continuation of Monday's strength as we traded into some key resistance numbers. As I mentioned in yesterday's commentary, I expected to be sandwiched between the 40-day moving average and the 10-day moving average, and the 10-day was hit exactly, and the market backed off of there. And in the last few minutes of trade, we managed to rally back to close just above the 3,400 level, basis the S&P 500. While this looks encouraging, there's still a ton of overhead resistance. I'll go through all the details here in a few minutes. Today's action will be all about the FOMC release and Chairman Powell's conference call. And while many don't expect anything new, we know that interest rates are going to stay at zero, but do they have anything they can talk about that will help to stabilize the markets? Now, we saw a huge decline on the NASDAQ, nearly 9% in just as many days. This decline, I'm sure, brought some concern into the Fed, but I don't expect to see them do anything drastic at the moment. I've talked a lot about what I believe is necessary, and we need a fiscal response. This will be all on the House and the Senate to come up with some type of stimulus bill, and they need to do it quickly. Now, there seems to be a lot of resistance before the election to do anything, but there's a lot of folks that are starting to hurt, and they're getting a lot of pressure across the board on both sides of the aisle to get something done. But as I've said many times, is that the Fed's monetary response has to be met with a fiscal response. Without that, this is not going to work out well. You can't just support the capital markets and the bonds and stocks and those things and expect the economy to come back. It's just not going to work that way. We'll have to see if we get any leaning towards some sort of deal that's going to get a stimulus. One of the biggest things out there right now is, at the moment, California is still mostly shut down. But right now, over half of the people in the continuing claims that we're going to see on Thursday are in California. So if you just open up California and a couple other states, we see that continuing claims number drop from 13.2 down to maybe 9, few as 7 or less, very quickly in a few weeks once those economies start to open up. Until they do, there's not going to be a lot of optimism on the street. So this is part of what I've been talking to you about, is that as we go through September and October, we're going to continue to see these numbers grind out, and we're going to see a lot of volatility in the economic numbers, and we're going to see things miss. Now, yesterday we had industrial production come out. It was expected to be up 1%. It came in 0.4, a little worse than expected. There were some other numbers that came out that were as expected or a little bit better, but they weren't material numbers. Today, we're going to see retail sales come out. That's expected to show a 1% gain. It will be interesting to see how that comes out, but there's some housing stats and some other things. I don't think markets are going to be keyed into any of these metrics with the FOMC meeting today. So back to the Fed, they're going to need to make some sort of statement that will keep the market stable. If they miss the mark here, we could see quite a bit of selling. Maybe they'll come up with a new program. Can't imagine what it would be. They've done everything from A to Z so far, but we'll have to see what they come up with, and market participants are going to be parsing out every word like they always do in the Fed statement, and then when Powell talks, they're going to be picking this thing apart. The good news is I will be doing a live stream from 1:30 to 4:30 tomorrow, so we'll be able to cover markets reaction and talk about the comments that are made as well as the statement in a real-time mode. So I look forward to that. So tonight's video is going to be somewhat brief. I'm going to cover S&P, NASDAQ, and gold. I will go into a lot of depth on the individual stocks, S&P, and many other metrics tomorrow on the live stream. So let's go ahead and take a look at the charts, see what they're telling us for Wednesday. As we review the WaveTech database, we're continuing to see some traction as the markets close higher. The database has moved up to 17.29% bullish from a 14.5 just 2 days ago. We saw 837 new buys today, 167 sells, so roughly about 670 net buys. But one point here is that we only got 281 3.2 buys. Over 60% of the trades that come out of the short-term database are optimized to the 3.2 model. So there's two models that we have in the system, and one addresses a more aggressive, more volatile market, which is 1.2. 3.2 has a better track record overall as far as the performance of the models. It's mapped out to the best total net profit on any symbol. So 3.2 is much more dominant in the short-term models. So we're not seeing as much traction there. And I've said this over the last several sessions now, if we remain under 26%, that will tell us that the markets are going to rotate and potentially see some more negative downside over the next several weeks. So we've got lots of work to do here to determine what is going to be going on as far as the database goes, and therefore it will give us some insight into the rotation and some of the other elements that are going on in the broader markets. But this gives us a much more in-depth view of what's going on. Beginning with the S&P 500 futures, we're seeing overnight some moderate strength as the futures are currently up 2 handles right now, but there is something that is really dominant here. That is the 10-period moving averages at 33.96. We're trading right now exactly at that level, 33.96. We spiked just above that to 34.0350 intraday. Looking at the grid, you can see R1 is 34.08. S1 33.81. We have traded down to 33.85 overnight. So we're working basically an S1. Maybe we'll see R2. There's a good chance that we've already seen the overnight highs, and we might see some protection coming in tomorrow ahead of the Fed. One of the key elements here to continue to watch is that PPM1 is now at a minus 0.35. That is a downtrend. That resistance number is 33.96. PPM1 tracks the 10-period moving average. It tells us there's only about a 30% probability to close above that 33.96 today. So there's definitely some downward pressure. We're flat on PPM2 at 0.04. And then PPM3 has a slight positive 0.12. As we look at the numbers overhead, you can see that the 34.16 is the 21-period moving average. So that's also going to be some resistance at these numbers. And as I've been discussing over the last couple of days, I still believe that the primary trading that's going on will be between the 40-day moving average, 33.55 on the futures, to 33.96, and now possibly trading up and spiking up to the 21. The moving averages will be dominant in this pattern, defining where we're going to trade. The other thing is we look at the grid, like I said, R1 34.08, S1 31.81. It's possible we could see a print down towards 33.67. We're not seeing any type of increase in the PPMs with this strength that we've seen for the last couple of days. In fact, we're seeing an acceleration on the downside of the trend. This is setting the tone for a potential decline about a half hour before the London opening right now. We're seeing some moderate buying coming in. They may challenge the 34.0350 high. By the time we come in the morning, we'll see some pressure coming into the open of the U.S. Going to the cash S&P, yesterday's high was 34.1948. Now, during the time when that was being hit, the actual calculation was 34.1953 intraday. By the time the close came in, we closed down at 34.01. It did cause the 10-period moving average to downtick slightly, but basically we were able to reverse off of those levels. We also had R2 there at 34.1590. So there was plenty of resistance. As we look at the grid, we're seeing a contraction of the volatility over the last 3 days. This stabilization typically will lead to another spike in volatility and the possibility of seeing the market starting to challenge some of the lower levels. And just like in the futures, the 40-day moving average is 33.65. We have 34.18 is the 10-day moving average. It is dropping about 10 handles per day, so 34.08 will be a key number. But you also see, looking at the grid, you also see in the grid that R1 is 3411.28. So the resistance overhead will be 3408 to 3411. And then the grid on the cash suggests a minimum move down to 3191 and possibility of seeing 3379. I think just with the negative ppms here, we're likely to see an R1 S2 type print number. Well, I am looking for some weakness. In spite of the last 2 days strength, as I just mentioned, we are not seeing any upward acceleration in the momentum, which tells me we're likely to see these resistance numbers I just discussed hold. Now, if we did get above 3411, then R2 is 3422. That also goes right in line with the 21-day moving average at 3426. So I believe these markets will be met with quite a bit of resistance overhead. I don't expect them to run away. We'll see how things come out. We'll be in a live stream from 1:30 to the close tomorrow. The next market I'll cover is NASDAQ. And this, as I mentioned last night, has a more extreme negative profile than the S&P does. The PPM1 right now is at a 0.72. In spite of the overnight strength, not a lot, 0.19 up 23 handles on the NASDAQ futures, we're seeing a downtick in PPM1 and an acceleration of the downtrend. 11,455 is where that average is. We're trading just above that at 11,474 right now. I suspect we will trade back below that as we come into the open of the US. But just like in the S&P, same type analysis, R1, 11,523. And there is a very critical number on the NASDAQ to keep an eye on, and that's last week's high at 11,572. A penetration of that level would actually negate any further downside and would suggest that we would go into a sideways mode. So far, the high of the week has been 11,496. We'll have to see how this plays out over the next couple of days. Looking at the NASDAQ futures weekly chart, we're currently trading just above the R2 number, 11,463. The high's been 11,496. We're above that level currently at 11,476. I would expect to see the 10-week moving average be the dominant support level in the NASDAQ, 11,175. If we were to finish below that level this week, that would cause some further technical damage. But for the moment, it looks like that's your primary demand line. If the market did trade down to 11,175, there's going to be substantial support at those levels. The final market that I'll cover tonight is gold. And as I mentioned in last night's analysis on gold, that there was quite a bit of resistance between the 1982 to 1987, 88 levels, which was here on the grid. This was yesterday's range we're looking at on the screen. So this is, the high was 1982, the low was 55, and we finished at 66. Basically, we're unable to trade and maintain anything above the R1 level even on the pattern. So this was somewhat negative, but we are seeing the PPMs starting to turn up. I discussed this last night. It does appear the pattern's setting up for a potential breakout, but there's just a ton of resistance here. And a lot of that has to do with some of the relative strength in the Dow. Even though we've seen a couple days of Dow weakness, we did see a nice rebound yesterday, and that's what caused gold to sell off. So there's definitely some cross currents in gold on a short-term level. The weekly chart, the dominant moving average will be the 10-week moving average. It's up at 0.75. It's holding its second derivative, so this is a good sign here. And we're looking at so far on a weekly grid number. R2 was 1984. We had a high of 1982 yesterday. We haven't been able to print anywhere close to an S1. So far, we've traded between R1, R2. It basically would call it an R2 hit. And we're seeing that support line at 1948, which is the 10-period moving average. With the PPM at 0.75, there's only a 30% probability for gold to move below 1948. If we did dip down toward that number, anywhere between 1955 to 48, there should be a trade off of those levels, but I don't see this pattern in a breakout pattern just yet. Going back to the daily chart for a minute, I believe there's more time that we have to work in this sideways range that we've been in since August. We're just not able to get any type of real momentum going in gold to break it out, to get and challenge those highs that were printed back in early August at 2,089. My expectations as we go through the balance of the week is to continue to stay within the daily grid right now. The high end is going to be 1990. We should remain above S2 on the daily because, as I just mentioned, the 1948 is a substantial support line, which is the 10-week moving average. So we've already traded R1 today at 1972, the high 71.60. So just expect to see a lackluster trade. Maybe something that comes out of the Fed can stimulate this, but these parameters I just laid out is where gold is likely to remain. This will complete the video. Remember, we have the live stream at 1:30 New York time tomorrow, Wednesday. I'll see you then. Thanks for watching.